What do earnings say about the state of the US consumer? Welcome to Market Insight. I'm David Pollard. Investors continue to digest what has, so far at least, been a positive earnings season, but there have been some signs of weakness in the US consumer, not least in today's earnings by Shopify and Uber. Well, to give his take on all this, I'm now joined by Keith Gangl, Portfolio Manager at Gradient Investments. Welcome, Keith. Many thanks for joining us. Let's start with Shopify. Is this indicative of more to come for consumer stocks?
Yeah, it'll be interesting. I think part of the reason that you've seen such a negative reaction to Shopify is expectations were really, really high. Their numbers themselves were kind of in line, but instead of growing 20% plus, now they're in the high teens, and that's not good enough for a stock with a high multiple. But it maybe is giving us some insight on the consumer if they're starting to weaken a little bit. We've had some other data points in the past. We've seen Starbucks a little bit, McDonald's a little bit weaker. So that is certainly on the top of a lot of investors' minds, and I think that's why you're seeing such a negative reaction and the stock down about 18-19% currently here.
Well, Uber is another stock in trouble today. What's your take there? Has Uber run out of steam?
I don't think Uber's run out of steam, but again, expectations were high. A lot of these names are kind of re-rating higher. They actually had lost money. Their EPS was negative, and the street was looking for a positive 22 cents. They actually came in at a negative 30. So when the expectations are high and you actually miss on EPS, stocks can react negatively, and that's what we're seeing there. I don't think the game is over for Uber as yet, but I do think they're actually misstepped here, and that's why the stock's getting hit a little bit.
Let's also talk about Disney. In your notes, you talk about a less robust US consumer. In regard of Disney as well, its shares sank yesterday despite posting a profit in its streaming business. So what does this tell us about not only Disney, but the wider sector?
Yeah, the negative for Disney yesterday was more on the parks related. Parks has been their all-star. I mean, their direct-to-consumer streaming has been a little bit laggard now. It's kind of hits and starts, but everybody's focusing on parks, which has been so good. They actually saw a little bit of a consumer slowdown there. That's what's making everybody worried about the consumer. But the parks are not cheap to go to. So as the consumer's getting a little bit stretched, they're starting to pull back, and that's actually what hit Disney. So people are starting to worry about that. Maybe Disney's kind of hit their upper limit of raising prices there.
And what about the broader picture, Keith? More generally, earnings have been positive, but not enough to push the market to new highs. So what's your outlook there?
Yeah, earnings been really good, and we're about 80% through the earnings season so far, and I think it's roughly about 77% of the companies have beat. Normally they do beat, but the 10-year average has been for about 75% of beating. So we're actually upsizing there. The EPS growth has been about 5%. Revenue growth has been about 4.5%. And so if these numbers continue, we're going to have a year-over-year change on EPS about 9%. That's the best growth rate we've seen since Q2 of 2022. So things are actually positive, and their guidance has actually been slightly better. So even though the stocks have come off a little bit, you got to remember when you back up before the earnings season started, the markets were up almost 10% going into earnings season. So they gave a little bit back. Now the market's actually we believe, going to grind higher over the course of the rest of the year.
And finally, Keith, I wanted to ask you about Tesla. This is a company that's beset by a stream of very negative news, not least of all today with the reports of a Department of Justice probe. Is this a company that investors should now stay away from?
Yeah, it's a company we haven't owned, but we haven't owned it because of valuation. But there's certainly seen a lot of negative news lately. Like you mentioned, the Department of Justice news this morning. We have, what's going on in China, the slowdown there with their EV makers, other EV makers gaining market share on Tesla. But, I mean, the stock actually reported, a couple of weeks ago, and they actually had a very nice pop. And the reason it popped was because Elon Musk actually went over to China, and he's trying to figure out what they need to do to make their production and regulation there for to get them back on track over there. So again, I think there's a lot of issues there, and valuations are our main concern. But I do think he's doing the right thing by making a step going over to China.
Okay, Keith, it's been great to hear your thoughts today. Keith Gangl of Gradient Investments. Many thanks for being with us. That is your Market Insight. You can watch more videos on Reuters.com.